Hey, what's up guys? This is Leo and welcome back to another Layman's financing video. Today we're going to be going over student loan refinancing and if it might be a good choice for you. So just like always, we're going to dive right in and answer the obvious question. Oh, watch my microphone. What does refinance mean, or what does refinancing mean? Well, easiest way to put it, it means to replace your current loan with a new loan. A lot of times you'll hear the term refinancing when you're talking about a mortgage, but it can be anything from student loans, like we're going over now, to mortgages, to auto loans, personal loans, anything that you're going to take an existing loan, change the terms of, or move it to a different lender is refinancing. There's a few reasons to generally do it. Most times it's to lower your interest rates or lower your monthly payments. It may also be to lengthen or shorten the term of your loan. Generally, it's used to shorten, the terms, and especially if we're talking about student loans, that's generally why we do it. Or if you just don't like your current loan provider or any of the terms of their loan, and you find another lender that has more preferable loan terms, that would be a reason to refinance as well. So before we can get into exactly what refinancing a student loan is, you need to understand the two different types of student loans. You have federal loans and you have private loans. Generally, federal loans, and we'll go over it a bit later, you don't normally want to refinance those. They generally already have pretty low interest rates, definitely compared to your private loans. The interest most of the time is subsidized while you're in school. So while you're taking classes and everything like that, the interest is subsidized. You don't actually pay it. And there's a lot more options for hardship and repayment. So if you lose your job, or for whatever reason you can't make some monthly payments for 3 or 4 months, or or more, federal loans are way more lenient with allowing different options for that. Private loans, you pay your monthly bill, that's it. A lot of the lenders out there don't have many options. Of course, there's caveats to that, and there's some lenders are going to be different than others, but in general, that's usually what you see. So we already went over it briefly, but you might be asking, why refinance? Well, like we said before, with any other type of loan, generally you want to refinance only private loans, not the federal ones. You can get better rates than when you took on the loans. I know in my case, my private loan was at, we'll say, 7.65%. You can refinance to as low as 2.65%. That ends up being thousands of dollars at the end of a loan term. Federal loans can be refinanced, but it might not be worth it because of the already low interest rates that they're at, and again, the favorable payment terms. And just really quick, I kind of skipped this. You can lower your monthly bill if your interest rate is lower, and more of your payment will actually go towards principal versus the interest when you do have a lower interest rate. And what we're going to do is we're going to look at actually some real world numbers of actually my own student loan that I was able to refinance, just to give you an idea of what kind of price point you'll be at, or what kind of savings you'll be at. So I had, my original loan was for $11,500. I had financed through My Great Lakes. That's who my loan provider was. The interest rate was 7.65%, and my minimum payment every month was $219. At the end of, we'll say, 10-year or whatever the loan term was, this is what's left. It's about 5 years left. This is at the end of that 5-year term, I would have paid back $14,048, for that student loan. And that's not too bad. It's a few thousand in interest. That's just kind of what happens when you borrow money. But I refinanced my loan with Citizens Bank and was actually able to get, it is a variable rate, and we'll go over that. But I was able to pay off this Great Lakes loan, take out a loan with Citizens for the same amount. That's what refinancing is. I was able to lower my interest rate to 4.5% and get my monthly bill down a little bit lower to $215. But at the end of the 5-year term, I'm only paying $12,900 versus $14,050. So that's about $1,000 savings over a 5-year period. If you start with a higher interest rate, refinance for a lower one, or if you owe more than $11,000, you're going to see thousands of dollars of difference between the money you can save just by a few percentage points on that interest rate. That's why it's so important to start looking into refinancing. So you may be asking what the catch is. Obviously, if everybody could just refinance, everybody would be doing it. Why isn't everybody doing it? Well, For one, you usually need a decent credit score. Think low 700s to 800s, 720, 730, 740. A lot of the higher end student loan refinancing companies won't even consider you to your 750, 760. So you do need a pretty decent credit score to do this. If you're looking to refinance a Parent Plus loan, which is a student loan that you needed your parents to co-sign on, it may temporarily lower your credit score, even for a couple of years, because when your parents co-signed on the loan, it was actually in their name, not in yours. So all of a sudden you're taking on $15,000 worth of debt that technically wasn't in your name before. So that increases your debt to income ratio, which in turn lowers your credit score. It is only temporary, and as you make payments to and lower that principal and lower that debt amount, your credit score will gradually increase, and actually you'll probably be better off because of it, because you have that payment history on a loan that was strictly just in your name. And again, because you're refinancing, you are refinancing to what is a private loan. You're not refinancing to a federal entity. You don't have the same options as the federal loan. So that's why generally people say don't refinance federal loans. It's generally not something you want to do, because you lose those repayment options. You lose the forbearance option, which is being able to push off payments for a little bit and maybe just make just interest payments, that kind of thing. Again, there's lots of options for federal loans that you will lose out on. So definitely keep that in mind when you're looking to refinance federal loans. We talked about it briefly. When you're going to look at refinancing, you're going to see two major types. You're going to see fixed rate financing, and you're going to see variable rate financing. If you watch my credit card video, one of my credit card videos, you kind of know the difference, and it is fairly obvious, from the names itself. But there's a couple things to know about them. Fixed rate loans are normally a little bit higher interest than a variable rate loan. So that 4.5% interest rate loan I got from Citizens Bank, that would have been a variable rate loan. Whereas if I was looking, variable rate loan. Whereas if I was looking at a fixed rate loan, I might be able to get, it'd probably start at 5-6%, somewhere around there, because they are taking on more risk. Whereas with a variable rate loan, it's normally lower interest. In this, interest rate actually varies on something called the LIBOR, LIBOR. Make sure I got that right. I have to read my notes here, which is the London Interbank Offered Rate. We're not going to go into what that is. Essentially, it's an index that all the student loans get compared to, and it's usually, your loan provider will say, I'll charge you 2% interest on top of this LIBOR rate. So when that LIBOR rate goes up, so does your interest rate for your student loan. And depending on the kind of time frame you're looking at paying off your student loan, it may be worth it to get a variable rate loan, because even if, say the first 3 years of the loan are at 3%, in the last couple years it drops up to like 7-8%, something like that, even higher than your original before you refinance interest rate. You would have paid off so much principal by that point that at the end of it, you'll still work out on top. So that's something you might want to do the math out on and kind of consider. Maybe look at some of the LIBOR, historical charts and see if it looks like it's going to be going up. I know in the United States now they're actually talking, and this is of what's today, August of 2016. The central banks are talking about raising the interest rate. So this is a time where you might want to look at more towards fixed loans, because you just don't know where that interest rate is going to go. Again, fixed rate loans normally are higher interest rates, but they stay fixed for the life of the loan. Variable rate loans are lower to start, but may increase over time as you pay the loan off based on just that LIBOR rate. So sounds great, right? Well, what can you do to get signed up? Well, if you just do like a Google search for student loan refinancing, there's an absolute crap ton of different providers that you can go to get some good rates. I went through Citizens Bank. The reason for that was I really did like the SoFi, I don't really know how to pronounce it, SoFi financing options. They had super low interest rates. The problem is I wasn't able to get approved for the application. Even my father, who the loan was originally in his name, also wasn't able to get approved. So they are pretty strict with their credit score, and that's why I said one of the caveats of this is you normally need to have a pretty decent credit score. because they were offering rates as low as like 2.25, something super, super low. Earnest is another big one with really good rates, 3-4%. Darien Rowayton Bank, if I pronounce that right, again, very low rates, 3-4%. In my Citizens Bank loan, like I said, I actually did refinance, and I got it to about 4.5%. After that, essentially, you sign up, you go through the whole process. If your parents did co-sign on the loan, they're going to have to essentially do a credit check as well, because they're going to want to make sure that the original person is willing to move over the loan to your name. But other than that, once you get approved, they send a check to your original provider, and then from that point on, you'll make payments to your new provider, and it's that simple. So if you have any questions for me, definitely feel free to leave a comment below. If you like these types of videos, definitely subscribe. I'm hoping to bring out some more. I'm trying to get this content train going. I just need some ideas for some future videos. Like I said, if you like it, give me a thumbs up. If you didn't like it, thumbs down. Let me know in the comments why. Have a good one.